the idea of national capitalism, I think that's the term
Yes.
that Napier uses. It's the unwinding of globalization and global investments to that extent is a lot more difficult than they suggest.
Hello and welcome to the More Freedom Foundation podcast. I am Murray and I am not a financial expert, but I am joined with one, so I'm sure he'll be happy to explain this entire episode and not wonder why I brought it up. That is Robert
Delightful.
Morris.
Thanks for that introduction, Ray. I will say
It's always good to pass the buck.
Yeah, I like that. I would not describe myself as any kind of financial expert, but I have been delving into these issues a lot recently, sort of studying the Great Depression, studying world financial systems, that sort of thing. And what I've realized, and I think perhaps this is like the step to financial enlightenment that I think everybody probably goes through, and I'm just at the beginnings of it, is you realize that actually nobody has any idea what's actually going on here.
Yes.
And while I think I have mathematical limitations and like certain basic fundamentals that I continue to not be able to grasp, I begin to realize that not actually, the depth of not understanding that we have for these financial topics is immense.
Dunning-Kruger is also, it's like you understand so much that then you realize what you don't understand.
Oh, is that how that works? I've never quite understood.
There's debate over Dunning-Kruger.
Yeah, I've never quite. Whenever I've taken the time to Google it, it hasn't been worth my time to actually figure it out further. But it goes beyond just sort of incompetence getting above their level or whatever. Like Nobel Prize winning economists get this stuff wrong all the time. Essentially, Rory listened to a podcast.
Yes.
That he sent to me that I find very interesting and certainly brought up things that have bothered me for quite some time.
Okay.
And I don't think what this podcast suggests about China and about international investment in the United States quite connects to real possibilities, but I could be very wrong, and I think it really prompts some interesting discussion, or at least thoughts, we'll see whether it's interesting discussion or not, about potential financial collapse's future or potential changes to the world economy.
The Div McWilliams podcast, one I've brought up before, and it was a man called Russell Napier.
Mm-hmm.
Now, he seems to be like a very high up economist, as well as like when you subscribe to someone for like over $1,000 and they tell you what you should invest in for the next year, like he's really top tier. He's not your classic like give me $50 and I'll tell you how to do drop shipping sort of bro.
Yeah.
Like he's a very highfalutin economist.
Yeah.
And just to bring us back to what may be happening, he's from Northern Ireland, but he now lives in a place called Black Isle in Scotland. So he currently lives in Invergordon, which is home to a mutiny that kind of brought the end to the gold standard. Am I right?
Certainly it ended the UK's attempts to hold on to the gold standard. So what Napier and McWilliams are arguing is that something that's very true, an observation that has been troubling me more and more and more, which is that the extent to which the United States is dependent on not just Chinese money, but everybody's money for its current stock market valuations is getting insane. We've talked a lot in U.S. economic political discussion about the actually somewhat limited question of how much U.S. government debt is owned overseas. It's actually a problem that's kind of diminished. People used to be obsessed about this in the aftermath of the global financial crisis, specifically the fact that China owned as much U.S. government debt as it did. But what McWilliams and Napier are talking about in this podcast goes to a much bigger topic that isn't as easily quantifiable. It is
No, it's a little bit confusing.
it is actually quantifiable by a statistic that has bothered me for years, and I'm actually kind of delighted that Rui's given me the opportunity to talk about it. Yeah, called the Net International Investment Position of the
Hmm.
United States. It is the NIIP. It is a fascinating and terrifying number because it gets to sort of my sense of how the British Empire ended. And if you look at NIIP, the United States is in a dramatically worse position than the British Empire was at the end of, which
Wow.
is something that I've thought about for quite some time. And this podcast was actually really helpful because it helped me clarify why that NIIP is so very bad. So it's not just U.S. government debt, it's the fact that, and this has gotten dramatically, I think, worse is a way that I would characterize it, though many would say in the United States, say, actually, this is fine, this is great, is that the United States, certainly since 2008, has provided such dramatically better investment prospects than anywhere else in the world, anywhere in Europe, anywhere in the industrialized world, even in China, that everybody's money is just flowing to the United States. The most dramatic example of this was responsible for a extraordinary $4 trillion drop in the US's NIIP over the past year is U.S. equities, the Magnificent Seven, the tech companies that I think we've now become very used to, or this is almost in the past now. The news stories saying, "Wow, these 5 American companies are now worth more than the entire Japanese stock market, the entire German stock market." I think we might. I don't know if we've actually gotten to this point where the top 7 US tech companies are now more valuable than like the entire European stock market. I think we got there. Like, I mean,
Wow. That's
it's
terrifying.
just absurd. And that's a very strange thing. The fact that the investments in the United States pay so much better means that all of this money has just been getting sucked into the United States. And I think what McWilliams and Napier point out to on this podcast is like, that's our money,
Yeah.
like that's money that Europe is dumping into these effing, companies.
Well,
And Europe,
to give you an idea, the UK pensions only invest 4% in the UK, and it's something like 34% in America.
that's a great stat. That's a really useful stat. Yes. And it's so I think what McWilliams and Napier are pointing out is like, this is nuts. Like, Europe is in the economic doldrums, is in this sort of stagnating position, in part, I think because, I don't know, in part because all of our money is investing in the United States.
Well, because I'm always brought back to Uber. Is Uber still unprofitable?
Uber is still unprofitable, yes, I believe.
So you have a company that really is only doing well because everyone's putting money into it.
Yeah.
So
Mhm.
theoretically, Europe could do the same, but maybe it might have a company that would actually make money. It's just a lot of American companies do seem to be like, oh yeah, we just dumped a bunch of Saudi money into it. Now it's great in the stock exchange. Oh yeah, it's hemorrhaging money, but that doesn't
Yeah.
matter.
Yeah.
Everything's a bit like built on sand, it seems.
That's what keeps bothering me, is that all of this seems to be built on sand. But what's kind of extraordinary here is the the way that this kind of works for the United
America.
States, it's the greatest theme of this
Mm.
podcast, really. Everything comes up United States. It's like, so the classic formulation. It's like, if you owe the bank $1 million, the bank owns you. If you owe the bank $1 billion, you own the bank. And I think that is very much the situation that we're in here. So that international investment position. So my understanding of what happened to the British Empire is fundamentally that it was a net creditor country. Even when it was beginning, its economy was becoming smaller than the United States
Hmm.
in the 1890s through the 19 teens. Even when, actually, I think this is really exaggerated, but on some levels, in some manufacturing disciplines, it was falling behind Germany and the United States. It didn't matter because Britain was so wealthy and had built up this historical position of wealth where, yes, U.S. industry was surpassing Britain in some ways. Yes, the U.S. economy was larger in some ways, but the British owned all of it. Like the British owned the best investments in the United States. They owned a lot of, even in Germany, they owned a lot of the best investments. They just had this incredible wealth. They had this much higher. It is what I'm talking about. What Britain had was the net international investment position. I don't think that the data series for this goes back
Oh
to
yeah, yeah.
that era in any kind of
Gets a bit fuzzy.
yeah, it gets much more fuzzy. We do have, at least since the 1970s, I think, an established data series that is supposedly comparable of a net international investment position. And since the 1980s or thereabouts, or 1970s or 1980s, so what happened to the British Empire is that, okay, we've got a smaller economy than the United States. Maybe we're losing out in some small manufacturing sectors to the United States and Germany, but we still own everything. It's fine. And the incredible empire-ending screw-up that Britain indulged in was World War One. And between 1914 and 1917, the amount of money they had to spend, not just to keep their war effort afloat, but after, I think the Russians by
Yeah.
month 5 had to be completely bankrolled by the British, and the French by 1916 had to be completely bankrolled by the British, just completely flipped their investment profile. They had to sell off all of the good stuff they had in the United States for rock bottom prices. And then they had to start selling their own stuff. And then they had to start borrowing incredible amounts of money. So like their net international investment position, flipped. And that's the point at which that was like the end of the British Empire. So why isn't the same thing for the United States? Because the United States, that flipped in the 1980s. And I think the answer to that question is, what are we talking about here? What are the components of that? So I think before World War One, what the British had was a more variegated mix of things that they owned. They had government debt, they had railroads, they had businesses, they had this, that, the other thing. And then that all got concentrated into one overwhelming debt to the United States, frankly. Like that's by 1917, they were being completely kept afloat by the United States government. And that's what their picture was, as we talked about in the last episode. That was what their financial fundamentals were from the 1920s really down to today. That's not the picture that the United States has. The United States owes all this money because if you the calculation, the NIIP calculation, which I don't think Napier and McWilliams ever actually talk about this,
No, they don't.
but that's what they're talking about throughout their entire, is like fundamentally, if the British pension fund owns a whole bunch of NVIDIA stock, this is the most recent of the Magnificent Seven tech companies in the United States, then that is, in the NIIP, that is technically money that's owned, that's owed, well, not owed, but in this calculation of investment profile, that is technically an asset that Britain has,
Hmm.
that is a liability for the United States. But that's a very different kind of liability. And this, frankly, apocalyptic net international investment position that the United States has. We talk a lot about the trade deficit or the current account deficit. These are different figures that are indications that Donald Trump, among other political figures, are obsessed with in talking about ways that, we're behind everybody else. And I think the trade deficit on an annual thing, or maybe the current account deficit, will get to be, I think it's gotten close to maybe $1 trillion or something, at points, which is, big and scary. The net international investment position for the United States is a $22 trillion deficit.
That's the net, I think. The gross
That's
would
the
be
net. Yeah.
20 or 58 trillion.
So we owe 58 trillion and then we own 30 trillion or whatever is sort of how that works. So we are not but it's such an insanely large number. But what's interesting about this is the components. So Britain after World War I owed, just straight up owed $1 billion, which was a lot of money back then.
Yes.
Straight up owed $1 billion directly to the US government, which meant that the US government like kind of owed Britain $22 trillion. Like of this, so $22 trillion, and between 2023 and 2024, or maybe it's 2022 and 2023, this number escalated insanely. It went from, so our deficit went up by $4 trillion.
Hmm.
But most of that $4 trillion is the stock price of NVIDIA going up. It's not like Europe can, really has any control. They can sell that NVIDIA stuff, but if the NVIDIA price goes down by $10 billion,
They're in trouble.
they don't get, well, there's no recourse there. Europe doesn't get those $10 billion back. The U.S. government, it's going to the British government, was like, you're paying that money no matter what. That's debt. A lot of this net international investment position is equity values. And that's why there was this insane $4 trillion jump in our net international investment position deficit, was because the U.S. stock market did so well. And that's like part of the story here. And it's a weird thing that like this net international investment position, which was so cancerous and was essentially the end of British Empire, is just another tool of U.S. imperial control. Because fundamentally it's pension funds, which matters, but it's also like private equity funds and hedge funds, and importantly, the British and European financiers that run those pension funds or whatnot, that are benefiting massively from U.S. government, not U.S. government, but from U.S. investments becoming more expensive. So it's just another form of corruption. It's essentially what McWilliams and Napier are like, oh, there's this incredible opportunity where we could just take all of our money back.
Hmm.
But like
Well,
that
this is
incredible,
something Macron has talked about. It's basically like there's such a deficit. It's like Europe could invest in itself and make its own companies that are profitable instead of just putting everything in America.
well, that is a lot easier said than done. But the other aspect of this that I want to highlight is that like this is every elite in the world essentially becoming the Saudi royal family. And to be clear, the Saudi royal family is a huge part of this net international investment position. And I think is the biggest case for ending this situation, a much bigger case than Europe being like, you know what, screw it. It's like,
Yeah.
because the elites in Europe are now incredibly bought in to U.S. success. It's not a simple question of like, oh, well, if just that UK pension fund decided to dump all of its Magnificent Seven investments, well, if they were the first person to do
Oh, yeah.
it,
It's a great time.
then maybe they'd be able to recover some of their investment, or much of their investment. But if they do it on day one and then on day two, the German pension funds try to do that, the German pension funds are going to find that what was their $100 billion has become $50 billion. So like, and that's sort of the problem here, is the way that we've organized U.S. or the world financial system. And I think this is another part of what McWilliams and Napier are talking about, that they don't sort of explicitly connect it, is that we've organized world finance in such a way that the U.S. system is the only place that has any kind of attractive economic growth, which is just kind of nuts. Or specifically, has the kind of economic growth that you can invest in and make money off of. And that's a key difference between, say, the U.S. and Chinese economies. Whereas certainly there's been massive economic growth in China. Certainly there's been, there have been some investments that have been done very well. But fundamentally, the Chinese investment climate is not organized with its, frankly, insane obsession with shareholder and investor value that we have in the United States. The United States is just a better place to put your money if you want to be able to take more money out. So like that UK pension advisor is going to be sitting there and saying, look, like obviously it'd make me feel better if we were investing in British companies or this, that, and the other thing, and maybe that's a profile we would have, but I would be poorly serving my pension investors. I would be poorly observing the people whose retirements I'm supposed to be defending if I wasn't buying Tesla stock or Nvidia stock or Meta stock. It's an interesting dynamic that, like, yes, there's a lot of US things that have been going on, and I think McWilliams and Napier really focus on what China has been doing over the past
Yes.
30 years and saying that this is sort of at root, China made a decision that we're going to continue to bankroll US insane focus on shareholder returns and investment returns and keeping inflation low and keeping asset prices inflated because it's going to allow us to continue selling things to the United States.
So I think what China did was they talk about how China was constantly buying bonds to deliberately keep their currency low. Because usually what happens is if your country starts to do well, your currency gets stronger, then your products are more expensive, and then they're less attractive to the rest of the world. So China desperately wanted to keep. He says everyone does it, but I think it's just because China's at such a scale that when it does it, basically the world economies kept rising, and normally what happens is then interest goes up. So the two go up together. But because what China was doing meant you could have growth and then basically zero interest rates until COVID. So it's basically the fact that China was able to enable this to happen, and then everyone's constantly going into America. So the fact that we might be going into a world where we're going to get a lot of inflation might mean a lot of people take stuff away from America.
Well, I think what they're pointing to is that the Chinese policy has run its course.
Yes, exactly.
They've gotten to a point where
Did they stop buying bonds in 2014, something like that?
something
US
like
bonds?
that. Something like that, which is interesting because the big, and you can still see people writing about, oh no, China's, controls way too much of our debt or this, that, and the other thing. And actually they don't actually.
Well, yeah, that's what he keeps pointing out is the whole world is involved in an
Yeah.
American stock market.
Japan, I believe, is a bigger holder of U.S. national debt than China is now. So like that whole government debt story isn't really necessarily the story anymore. And even to the point where, and I think this is something that perhaps McWilliams and Napier, I don't know if they missed this, but I think they don't emphasize this enough, is it's not really like, I think they overemphasize the amount of power that China has over this. I think much like, actually, I think there's a parallel here to the petrodollar theory. I think that people who are really emphasize the fact that Saudi Arabia buys a lot of U.S. securities, like that was a key part in stabilizing the financial system after the gold standard in 1971, 72. That's a really good point, and I think it is true that the petrodollar was really, really important, but I think what people mistake is the idea that this can just sort of easily be reversed, or that if Saudi Arabia suddenly started doing something different, this is like this special key that's going to change everything. China already started doing something different. Like China already said, no, we're not going to keep buying as much debt as we've been buying, US government debt. Like absolutely Saudi decisions in the 70s, Chinese decisions in the 1990s contributed to this US investment monstrosity that is sucking up the investment capital of the entire world. But I think what McWilliams and Napier do here is they overemphasize the ability that China has to stop it. To like, just because China has a different priority now, China is now, and after Xi Jinping, it seems like Xi Jinping is sort of like the last holdout for like, no, but let's keep the currency low and da 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 da. It really does seem like China's beginning to realize, or at least beginning to accept what economists have been shouting at it for 20 years, which is you can't grow your economy anymore by export alone. You have to start doing consumption. You have to start allowing more of the Chinese people to become a little more like the US public and start consuming. Like it seems like China's about there, and that absolutely will bring significant changes to the world economy, perhaps in the long term, make China a more attractive place for investment that competes with the United States a little bit more. But I think that the idea that, oh, this dynamic doesn't exist anymore is because honestly, like this was something interesting that Brad Setzer pointed out, like the petrodollar dynamic that helped to solidify the post Bretton Woods financial system in the United States. That doesn't exist anymore. Like Saudi now, I think spends more money on itself or something like that. I didn't quite like. There just isn't as much of a. There isn't
Well, I
as
think because
much.
Saudi Arabia nearly have to, they can't just spend silly amounts of money. They just have to spend a stupid amount of money. It's like they're slowly having to sort of worry about things that they used to never have to do.
Yes. So fundamentally, there's still this immense
Yeah.
pool of Saudi capital that's invested in the United States, is buying up, is booing these stock prices. That's part of the story. But like the Saudi economy is no longer in surplus anymore. Like it's in deficit. Like it's already, sort of spending money into that. So like that dynamic, the petrodollar dynamic that solidified the post Bretton Woods U.S. system is over. I think that McWilliams and Napier are correctly identifying that the Chinese system that helped to supercharge the current financials, U.S.-based financial system even more extremely than Saudi petrodollar stuff in the 70s did, is ending, if not is over. But I don't think it follows necessarily that everybody's going to move on from the United States now.
Well, he talks about like a new Bretton Woods and the fact that he feels like America isn't going to let this happen. So he thinks there's going to be, because they also talk about how we're currently in the period that has no name. It's
Yes.
like it's kind of just like China did this thing. America was happy because it was getting money, and then Europe just sort of was a bit passive in all of this. But it never really had an official name. It just sort of was. Everybody seemed to be doing well, so nobody wanted to rock the boat. And it feels like if as you talk about, let's say the UK pensions first, and it looks like everyone's about to pull out of America, it's possible there might be like, right, we're going to have to come up with a new financial system. But he doesn't sort of hint at what that could be. It's just the idea that America won't let this happen because it's maybe not as, militarily and stuff, but it's maybe not as powerful as it once thought it was. And this could be a chink in the armor. So it might be coming up with a whole new world for the next 40, 50 years.
Well, so what's key here is that I think that it's a good point, is that a lot of Trump's more extreme proposals or more extreme attempts to decouple the U.S. from Europe or from China, like I think it's true that Trump is not sitting on as firm ground in making these arguments as he thinks he is, because of this because of this net international investment position, but he's not on as weak ground as McWilliams and Napier suggest, because of this problem of, they put so much money, Europe has put so much money in the United States that, we kind of own Europe's elites, because the amount of money that they will lose, in attempting to repatriate this capital is so like complicated. The way McWilliams and Napier are looking at it is like, hey, it's this threat. Like, hey, we're going to stop letting you create all these Googles and NVIDIAs and Teslas off of our investment capital. Trump could turn around and say like, cool, well, then we're not going to let you have the benefit of these investments that go up 10 to 20% every year. So there's that flip side to it. And it like the idea of national capitalism, I think that's the term
Yes.
that Napier uses. It's the unwinding of globalization and global investments to that extent is a lot more difficult than they suggest.
But is it possible if this, what was the term, Golden Seven?
A Magnificent Seven is the current.
If they start to have a couple of rough years, could you then see a lot of people going, well, we're not getting these incredible returns anymore. Things have started to stagnate.
Well, I think absolutely. And I think the fact that so much of the investment in these companies is reliant on is absolutely a worrisome point. There's AI. AI is this.
Because I keep seeing computer scientists saying there's a sort of plateau with it. So even if you just throw more hardware at it, it still reaches this plateau, and then they keep trying to train AI on itself, and then it just turns into garbage. So it's there could be it's they keep talking about, oh, there's just going to be this super intelligent AI, which I always think is marketing nonsense. I'm always reminded of, is it subliminal messaging? Did you ever hear about when it came about? There's this man, he basically wanted to prove like, oh, I'm such a great marketer. I can do the subliminal messaging. And then it was like some cinema sold slightly
Mhm.
more
Mhm.
drinks or something, or popcorn, but it turns out it was all kind of nonsense. And I feel like the idea that, oh, there's this spooky subliminal messaging out that can control everyone's minds is a bit like, oh, we're going to create God with AI. Like, it's instead of you going, okay, let's look at it in a granular detail in a way that will affect my life, you're like looking at some airy fairy thing. So AI could possibly, be a nothing or just hemorrhage money like Uber for years.
Well, I think that AI is not a nothing. I think that specifically, even the very small subset of AI that we're all thinking of as AI, the sort of Chat GPT, the large language
Language
models,
model.
something along those lines, like they are significant. They are changing the way that work is done. But this is something that I am old enough to remember in detail, and I was spending a couple summers on Wall Street while this was happening, is that we had a tech boom and crash in 1999 and 2000 in the United States that already, had international implications. That was a very, very big deal. And the internet, I think I don't know enough and haven't dived in enough to parse claims of whether AI is all just marketing fraud or whatever. I don't think it is, but let's assume that it's not. Let's assume that it's actually is incredibly worthwhile and transformative on the order of what the internet was. The internet had a huge, huge boom in 99, 2000, and then everything crashed catastrophically. And the valuations of these companies that are now incredibly are part of the Magnificent Seven, Amazon, Google. Well, I guess Google wasn't even public back then. I'm sure Meta wasn't. But Microsoft and Amazon, which are members of the Magnificent Seven, very much were public back then. And their prices didn't recover for like 10 years or what have you. And that possibility is very, very real. And what is that gonna do to, because it's not just every country in the world that's overinvested in these 7 companies. It is, every baby boomer that's trying to retire.
Napier talks about how we're essentially,
Mhm.
it's stereotypically that the boomers seem to get everything, while he's basically saying we'll try and do the same in reverse, but slowly. So taking from pensions and then using it to build infrastructure in your own country instead of investing everything in America.
The problem is, how do you do that slowly is the
Mhm.
thing. And I think which didn't come up in that conversation and is a very big part of my current thinking is like, I really think we're actually already beginning to see Saudi Arabia trying to sell off its investments. And you can be very confident.
Their investments in America.
Well, yeah, because they have to. I mean, they are borrowing, and I don't see, even if you don't believe in the end of Saudi Arabia by 2030 system, a sort of proposition that I believe in. Absolutely, Saudi Arabia is going to start liquidating their tech investments at higher and higher. And a lot of that stuff is venture capital, private equity, smaller companies, this, that, and the other thing. A lot of it, they have big stakes in all of these companies. And what happens when they have to liquidate some of those big stakes? Are they going to create that moment where everyone's like, oh, wait a second, and the value of these companies plummet? So I don't, the chances of these European countries being able to benefit from these investments at their current prices seems very, very unlikely to me. I think it's likely that the Gulf countries are going to be the first movers on liquidating
Mhm.
these investments. And, the baby boomers in the United States and the UK pension funds and are going to be sort of bag holders is sort of my concern.
Wow. Do you
So,
feel Napier's very anti-Chinese? Because I was listening to another interview with him, and he basically was like, "Well, China's already in a proxy war with us. They're funding Ukraine or funding Russia in the war against Ukraine, giving them small supplies and stuff and buying Russian oil. And they're also funding Iran because they're buying their oil and stuff. I just felt like, oh, we need to be in a club with America. Let's get a new deal going. Let's get the next 40 years sorted. And we're going to punish China because they dared to be a economic
Mhm.
superpower.
Yeah, well, I mean, if he's making this case for national capitalism, I think the logical next step here is like, well, investing in the United States is sort of we've done really well with it for 20, 30 years. Where are we going to get the next great investments? And I'm afraid nobody's instinct, least of all in Europe, is going to be, well, let's go build some businesses in the UK and Ireland and Germany. Like you're going to be like, oh, well, let's if China started actually privileging the Chinese consumer, started trying to create a more consumption-based economy, that's gonna be, I think people are talking about the second China shock at this point, which I think is a little overdone. That would be the real third China shock or second China shock if, China legitimately decided to start spending much more of its, money or discretionary investment capital on consumption base in China. So I think Napier is perhaps trying to keep that from happening because the logical shift is not from US markets to European markets, it's from US markets to Chinese markets, and even for European capital. So I can imagine Napier coming across as rather anti-Chinese. It's funny, now that you mention it, the thing about that podcast that struck me as very anti-Chinese is
Hmm.
being like decisions made in Beijing. It's like it was decision made in Beijing in 1994. Like what a tiny, tiny percentage of the US of the world economy China was in 1994. Like it is not decisions made in Beijing. It's not some like sinister plot on the part of the Chinese. It is the Chinese reacting to and figuring out the best way to A, protect themselves and then B, profit from the US decision to shift, most of its manufacturing capacity to China. This is not, fundamentally a Chinese plot. It is fundamentally, when you consider relative economic weight when these decisions were being made in the 1990s, fundamentally a US decision and a decision made by European capital as well. So yeah, I do think it is, though he wasn't saying as explicitly anti-Chinese thing. I mean, I think the way they formulated across those two podcasts is like, why can't 20 somethings buy apartments? Oh, because of decisions made in Beijing. And I'm just like, it seems
So
kind
yeah,
of
I think their
ridiculous.
argument is because most investments are done into America. One of the few things you can invest in Europe will be housing. So that has then made it go into silly prices, so normal people can't buy normal
No, no,
houses.
and I think to the extent that Saudi Arabia and then China, acted to supercharge the U.S. investment markets, does play like a role in economic woes, lack of economic development in Europe. But this idea that it is some sinister plot by them rather than a fairly weakness-based decision to know how can we best protect our investments. U.S. market will do that because we are maniacally focused on the shareholder and the investor above all else. And also, how am I going to get in good with the demonstrably insanely violent hegemon that controls the world? Like these are not like it's a little bit of victim blaming here, like, and it's like because the Chinese, yes, the Chinese figured out a way to build an industrial capacity, but fundamentally, the Chinese have privileged the U.S. consumer over their own citizens for half a century here. It is a bit blaming the victim, I think.
But
Um,
one point seems to be that now inflation looks like it'll be sort of here to stay for the next 40 years or so, and it might get significantly worse. Is that, I think, is sort of what might cause a lot of people then to take investments back.
Yeah, well, the problem there, Rory, is that the best defense against inflation is high investment returns. And the only market that is providing high investment returns is the United States. Like, so I think a lot about inflation. I worry a lot about inflation. And the answer to inflation is owning assets, not money,
But you could see
and
that the sort of America's now at its peak, for the next while. So it's like we've done all the investments we can, we've put in all the infrastructure we can. So it's time to go into Europe, which is sort of almost like ready for a boom because it's been so lackluster for so long. It's like,
neglected.
now might be the time to then put things back.
You could make that argument, but I think that a lot of people go with arguments like demographics, and U.S. demographics are better than European demographics. Like a lot of the Europe is never going to have as maniacally investor friendly an environment as the United States will. Europe, despite a lot of promise, still does not have the unified market that the United States does. By 20 years of that being promised, like it's there's a lot of things that lead me to believe that it just wouldn't work out like that. And I think that it is again a situation where maybe everybody hurts, but the United States hurts the least. But yeah, I mean, it's fascinating to think about, and it just because I am obsessed, as I've said, with
So
that.
what's your worry, since you've said this is something you've thought about a lot?
Well, it's specifically that net international investment position, and I think perhaps thinking through this as I have, thanks to that podcast, just said, I guess I'm a little less worried about the U.S.'s net international investment position. What is something to absolutely worry very, very heavily about is what happens when Saudi Arabia collapses and all of those investments start getting liquidated.
So yeah, theoretically, if the Gulf states just were like, nope, we're pulling out, we need this money, could you just then see a panic globally?
Yeah, I could see a sort of a serial collapse. It's so bad. Like from any, like I mean I took the Series 7 in the 90s or whatever. Like I was a licensed stockbroker or whatever, and it's just from like basic. And I was never, I mean, I did it for a year or two. Like it is, but just like as a baseline, if you know anything about investing from a personal perspective and certainly from a systemic perspective, to have everything, so many factors, so reliant on 7 companies that are all reliant on a probably fraudulent case around one technology, AI, is just mind-blowingly fragile. It's just, and that's what's scariest about this investment position. Isn't the idea of like some big threat against the United States, or like, oh, Europe, or they're gonna start holding us to hostage. No, it's like what's threatening is just like a lot is depending on the continued, not just the continued success, the continued uproarious outsized success of these companies that just can't. Like, it's just not like it's already been sort of fraudulently, I would say, like nearly fraudulent, not legally fraudulently, but dishonestly.
But like 1920s fraudulent, it wasn't technically illegal, but it should be.
Yes, just dishonestly expanded. I mean, you look at like the more I look into like a business like SoftBank, which is just, it's a Japanese financier who's got this really insanely optimistic approach. He won and lost incredible fortunes on the first tech boom. Like he basically just got a pile of $100 billion from Saudi Arabia and the UAE. And at a point when the tech economy was looking a little shakier before the sort of new AI explanation, like just injected $100 billion of Gulf money into companies like Uber and whatnot that sort of kept everything ticking along for long enough for there to be like this little crypto boom, which everybody now acknowledges was completely fraudulent and BS. And then this AI boom that came along, and when was the AI big thing? Was it 2022 or 2023? Like it's absolutely running on fumes and Gulf money, and it's just so
But
clearly.
also, isn't SoftBank famous for buying like loads of nonsense companies that go nowhere?
Well, sure, but it's sort of I mean, that is the venture capital model more broadly. You buy 10 companies and only one has to be,
Profit.
it's okay if 9 of them are garbage, if one of them is Google, that's sort of the bet that he claims that he's making. But of course, the problem with like a venture fund and how a lot of these people are making money and how SoftBank is making money is you make money off of the churn. Like I would argue that Uber is kind of a pets.com. It's kind of like a meaningless company that shouldn't be worth anything. But because you injected that $100 billion of Saudi money, because you've got all these people who now want to dump more money into AI that's worth anything, you can have a fund where really like 9 out of 10 or 10 out of 10 of these investments are worthless crap. But because this sort of bonanza has been going on for 10 years, you can buy and sell pieces of what's eventually going to be shown to be useless crap, but it looks like it's worth billions of dollars spinning back and forth. So that's like part of what's going on here. And that's what I'm really, really worried about as far as like this Magnificent Seven thing, because that's really fundamentally like that I think is the bigger, more interesting story than like, oh, Chinese decisions made back in 1990s is like what we're actually looking at right now, which is everybody's retirement. Probably most of the people in Europe, because most European pension funds investment in U.S. equities. Like everybody's retirements, the fates of the investments of every country in the world are all dependent on these Magnificent Seven companies. It just like it's to some extent they just keep going up because they kind of have to, because everything's dependent on it. And I've been reading about the Great Depression and like the dependence on these things will keep on going to insane heights until
I'm
it
also
doesn't.
quite scared that Tesla's one of them because, as someone that's into electric cars, I feel like Tesla was incredible for the electric car market, but I almost feel like
Hmm.
everything they needed to do, they've done. And also, when you consider that they're significantly higher value than what do you call it, Toyota. Like I know they keep trying to do this thing. Oh, we're an AI company, we're a robotics company, but they're really a car company, and they're not doing great in China at the moment, which was the golden cow for so long. Yeah, a lot of these companies are very worrying.
Yes, yes, and they
And
are.
also, you've heard about the problem Meta's had with AI. Basically, Meta, as in Facebook, used to give advertisers, it's like, okay, another way it's like, when like certain views aren't real views.
Mhm.
Basically, they were like, they'd give advertisers the real numbers. It's like, so many of these are bots, so many only looked at so many seconds. And they used to say, this is the real number, so this is what you're paying for. They don't give them that anymore because it's now just turned into an AI hellscape where you have fake posts and then fake replies to fake posts. So they're two companies that are like, huh?
Yeah. No, and there's a lot of going on here. And really the answer to all of this is broader based prosperity.
Oh, yeah, yeah.
Um
You got to spread that
like,
portfolio.
well, no, well, I don't know. I mean, diversification has been an incredible loser. No, I mean like inequality. Like I think that like we're reaching, this is just part, the Magnificent Seven stuff is like it is the fruition of the sort of Reagan ideology of like, oh, we're just going to make the rich richer and it's going to trickle down. Like we're in like this incredible distended, like all of the tech revolution, computers, like all of this, it's all just boiled down to this point of like, we're going to have these insanely inflated tech companies and everybody in the world is going to be invested in them. And then it's gonna pop.
But how many of these companies are essentially US government contractors for the military? Like the likes of Google, Nvidia, and Microsoft are definitely just, they're going to be getting bankrolled and be given secret tech and stuff like this.
I think that's not like it's becoming a bigger and bigger thing, but it is. I mean, these are massive consumer companies with real profits.
Yeah, yeah,
But
yeah.
no, but sorry, I just want to say like the idea that like we can have a rich and like profitable economy just by making the rich richer. I think like the reductio ad absurdum is the position where we're in right now, where like everything in the world is coming to depend on the continued profitability, continued insane, outsized, historically unprecedented, and probably illusory profitability of a few tech companies. Actually, we could have had more of like a New Deal, like where we were like more focused on everybody getting richer, building housing for everybody, educating everybody, unions, this, that, and the other thing. That kind of stuff's a lot more sustainable. Like, it actually creates a lot more economic growth. The fact that we're now just in this weird sort of pyramid based on these technology companies
Yeah.
is nuts.
But
And
do you
it's
think
not like it's not sustainable. Like, and it's a mental contortion, government contortion, financial contortion that has been created to avoid doing a little basic redistribution and providing services and business opportunities that wouldn't have like, 20% growth every year, but like would actually create a sustainable, better economy and world that wasn't at the extreme danger of collapsing, if just a few things go a little differently.
But do you think it's deliberately harming the American economy in the sense that I could see somewhere like Amazon, if it ever collapsed, the amount of innovations and companies and people doing their own thing that would come from its carcass would be amazing and completely change America for a long time. But instead, it just feel like, oh, please keep them all together. Don't let anything happen. These golden little companies, because otherwise we're all in trouble. Like, it's not really capitalism at this point. I know, obviously, you build to monopolies or whatever, but you just think the U.S. government's going out of its way, and it'll definitely go out of its way with Trump just to keep the
Mhm.
seven going.
Well, yeah, it's socialism for the wealthy is what it is. That's what is I think is a Bernie Sanders line. I mean, that's what we're doing. We're just creating this like this it is not a technically a pyramid scheme, but it is sort of like inverted pyramid shaped. Like I think everything is reliant on the continuing valuation of these companies. One extra point I did want to make about the McWilliams Napier point is that they were sort of talking about, oh, this is like the collapse of the gold standard. This is like the this, that, and the other thing. And I think a point that I'm sure that they're very aware of, but I think that is worth making is that this is not the first US-based system. This is actually, I counted up, this is kind of the fourth
Mm-hmm.
US-run system we're on at this point over the century plus of US empire. Very much as we talked about in the last episode, a little bit like starting in 1917 and in the 1920s and 1930s, it was a US-run financial system. In the aftermath of World War II, it was a renewed gold standard 1945 until, I don't know when the Bretton Woods Conference was, but 1945 until 1971, it was a U.S.-led gold standard system, thanks to, in part to the Saudis and others from the 1970s until the 2000s, it was a post-Bretton Woods U.S.-based dollar system. They talk about the sort of now sort of chimerica U.S. dollar system starting in the 1990s, and I think it did, its basis was in the 1990s, but it only really became like the dominating factor of U.S. of the world economy in the mid 2000s
Mm-hmm.
as China's economic footprint exponentially grew. So, and that is, I think they're right in pointing out to that like that this China U.S. based system has sort of run its course. And I think that this idea of national capitalism is like, okay, we're just going to split up and atomize isn't particularly likely, frankly. I think there's so many, I think we're most certainly heading to, unless of course we get a Great Depression and nuclear World War III that ends everything.
Wow.
We're most likely headed towards a fifth U.S.-led system.
Mm-hmm.
And what that's going to look like.
Who knows?
Yeah. I mean, there's a great Adam Tooze. I don't know if you're familiar with him. He's certainly been a huge influence on me, who's sort of a left-leaning liberal economist who has just distinguished himself by willingness to sort of engage with everything. And he had I think, sort of famous argument over the past couple years, really, but he had a new sort of salvo in that argument back and forth with a more traditionally leftist historian, and essentially just making the point that like we have no idea what's going to happen. And I think at root, McWilliams and Napier are mystified in that way as well, and just trying to make suggestions. Like, we have no idea what's going to happen next. And really, since 2008, we've been living in this kind of weird twilight zone of, well, the economics we knew doesn't make a lot of sense, and a lot of these data indicators are unbalanced in ways that we really don't like, but it all just sort of keeps limping along. And I think there's a broader and broader understanding that, like, things are not sustainable as they are. We need a new dispensation. Problem is just that for the past 8 years, and probably for the 4 years to come, the U.S. president, who is, for better and probably for worse at this point, responsible for determining what that next dispensation might be, is kind of asleep at the wheel. So we just don't know. It is potentially a time of great opportunities and great potential, but it's also one with great potential for crisis and damage. And I don't know, but hopefully we've shed some light on that today.
Well, I blame the Chinese. I'll see you next time.
All right.
The More Freedom Foundation is also available on YouTube and TikTok. Rob's Twitter is RobOLaw, and he's also written a book called Avoiding the British Empire, What It Was and How the US Can Do Better. And music provided by Kevin MacLeod.